Welcome to PenFinancial Credit Union's First Time Homebuyers webinar. We'd first like to thank you for joining us today, and we're hoping the information you find in today's webinar will provide some insight to the home buying process and give you some advice and some resources that you'll find useful in your search for your home and the search for your mortgage. The agenda for today's webinar, we're going to cover the pre-approval process, choosing the right home, and once you've chosen the right home, what are my mortgage options? We'll give you some insight as to putting it all together, and then we'll also talk a little bit about PenFinancial Credit Union and the credit union difference. So there may be a question out there from some of you. What is a mortgage? Well, most people don't have hundreds of thousands of dollars hidden under their mattress to pay for a home. So a way to own a home now versus own a home down the future when we've saved the money, you can seek from your financial institution a mortgage. A mortgage is essentially a very large loan secured by property, much similar to a loan you would obtain to buy your car or any large-scale item, just on a much larger scale with the mortgage. The loan is to be paid back to your financial institution in installments over a long period of time. So a car would be paid over, say, a period of 6 years. Your mortgage would be paid over in a much longer time, and for example, 25 years. For most, a mortgage is the most significant debt that will be amassed during a lifetime, and it represents a very large portion of an annual budget. So careful planning and consideration is required to ensure you choose the home and the mortgage that's affordable for you. Your mortgage professional, your mobile mortgage specialist, or your financial advisor at your financial institution will play a key role in helping you determine that. The first stage of the buying process is seek out your financial institution and look for what they call a pre-approval. What is a pre-approval, you might ask? Well, your advisor or your mortgage professional will sit down with you and they'll review your income, your assets, your liabilities, and your monthly debt obligations to determine how much of a mortgage you can afford, which will assist then in determining the price of home that you can look for. A pre-approval has a couple benefits. It not only gives you an idea of the price that you're looking for, but it guarantees the interest rate for a period of time, typically 120 days or 90 days. The benefit to you is that if interest rates rise during that period of time, then that interest rate won't rise with the change in interest rate. So it's guaranteed for a period of time. During the pre-approval application process, your advisor is going to discuss with you various things, including your source of down payment and what those options are. They'll review your credit to see if you're creditworthy of carrying a mortgage, and they'll let you know in advance whether you can be pre-approved for the mortgage and you can go home shopping. As far as credit's concerned, credit is a very important piece of the puzzle when determining whether you're eligible for a mortgage. And in most cases, first-time home buyers, because of the lack of resources in some cases, there is requirement to include a default insurance program, which comes from CMHC or Genworth, and typically they're looking for a minimum score, a credit score of 600 to qualify. Typically, the 600 comes from the fact that most first-time home buyers have less than 20% of a down payment to put down on the mortgage, which increases the risk to the lending institution. So this helps protect the lender. If your advisor goes through the process of the pre-approval and you are pre-approved for a mortgage, it's now time to go home shopping. But the best part is you're not obligated to follow through on the mortgage. So it's only the first step, and just to see if you qualify and how much you're looking at in terms of the home purchase price. To qualify for a mortgage, there's many variables. I've mentioned one, credit is one of them. But there are a couple of main qualifying criteria that you can actually figure out somewhat on your own to see if you qualify. I'm going to go over a couple of them that the financial institutions use most often. And the first one is determining, based on your income, how much you qualify for in terms of the size of mortgage. The calculations are based on income and the amount of payments that you currently carry. So the first one is what they call gross debt service ratio. This is basically to let the lender know if you can afford the home that you're looking at. It consists of the monthly mortgage payment, the amount of property taxes. If you're choosing to buy a condo, it'll include 50% of those condo fees, plus the amount of money it costs to heat the household, all of that divided by the total amount of income, gross income coming into the house. This can exceed 32%. So of all the payments that I make towards the housing payment, can't be more than 32% of the gross household income. The next calculation that they use to determine affordability is the total debt service ratio, or this is the amount that I pay for the house on top of all the other monthly payments that I'm obligated to make. That could be car loans, credit card payments, so on and so forth. So you take that monthly mortgage payment, property tax payment, condo fee payment, if applicable, and the monthly heating, plus all of my other debt payments, and that can exceed 40% of my monthly household gross income. So if you're well within those particular numbers, then you're well on your way to qualifying for a mortgage. Consideration for financial institutions and your financial advisor is where your down payment's coming from. There is a bit of a myth out there that you require a large down payment to become a homeowner. In fact, this isn't necessarily true. In some cases, you could own a home with no down payment. To purchase a home, your down payment could be no less than 5% of the purchase price of the home. It can be more than that, but it can't be less than 5%. Unless you're using some other form of a down payment, which we'll get into. So where can your down payment come from? You can come from your own personal savings. Maybe you've saved regularly and you have an amount in your bank account. It can be through investments that you may have you've amassed over some time. It can come from tax-free savings accounts. Remembering that what you take out of your tax-free account comes out tax-free. You can also use your RSPs for the purchase of a home, typically under the first-time homebuyers plan, which we'll talk about further on in the presentation. It can come from gifts from your family. So most typically you see it from parents or grandparents that have gifted their sibling or their kids or their grandkids money to buy their home. But it can also come from lender cashback programs. And this is typically where you would see somebody who may not need a down payment on their home with that piece. Touching on a couple of the most popular sources of down payment, I wanted to, because this is a first-time homebuyers webinar, is talk to you about the RSP first-time homebuyers plan. So Canada Revenue Agency has developed a program by which it helps first-time homebuyers get into home ownership sooner, allowing them to use money they have saved to an RSP over time. So if you're doing RSP contributions, you can actually use this money to purchase your house. Each purchaser, so if there is a spouse situation, both spouses can withdraw up to $25,000 each from their RSPs. These withdrawals can come out tax-free at the time of close or at the time you take possession of the house. The property that is being purchased has to be a qualifying home in the eyes of Canada Revenue Agency and must be intended to be occupied as your own principal residence in the year of withdrawal. The benefit can come out of your RSPs tax-free, so you don't have to pay the tax implication. But however, it can be paid back over time, and the time frame in which the government allows you to repay this is over 15 years. And they give you 2 years grace period because home ownership is typically expensive in the first couple of years. They give you a 15-year with a 2-year grace period to pay it back. Keep in mind, one of the stipulations with it is that your RSP contributions have to be in the plan or made 90 days prior to withdrawal for qualification in the first-time homebuyers plan. Otherwise, they come out as a regular RSP withdrawal. Another attractive down payment option, or maybe not so much a down payment option depending on what the money is used for, is your lender cashback programs. So some financial institutions have a lender cashback program, and by the word cashback, what we mean is that the lender will give a certain percentage of the mortgage amount, or in some institutions, the purchase price. They'll give a cash incentive, or say 5% of the purchase price, which can be used towards a various number of things. A, the down payment, or B, closing costs, pay down other debts. You can use it to maybe furnish the home or buy appliances, or even if there's something that needs to be done as far as renovations, you can use it for that. In most cases, people will use it towards their down payment. What happens in exchange for the cash that they advance, or the 5%, is that you'll pay a little bit of a higher interest rate. So they're essentially giving you the money saved that you and the interest rate up front and ahead of time. Another benefit to you is that the cashback doesn't have to be repaid. So as long as you remain in the mortgage for the term that the cashback's associated with, and by term, most typical are 5 years, then as long as you stick with that mortgage for 5 years, that money is not required to be paid back. So I've talked a little bit about the pre-approval process and some of the things that your financial advisor or your mortgage specialist is going to talk to you about. Now they've come to you and they say you're pre-approved. Now it's time to go find a home. So this is a big and important piece of the puzzle, because obviously this is the home you're buying for the first time. So I wanted to go over a couple of things that talk to you about choosing and what home to choose and choosing the right home. Because there are some variables that are important. Specifically, when looking at a new home, you want to consider the location and neighborhood that you're going to reside in. For instance, different municipalities have different property tax rates. In the Niagara region, for example, homes on average cost less in Welland, but the property taxes on average are higher. Property taxes in Niagara Falls are somewhat higher because of the nature of the neighborhood. So it's a tourist town. So where you choose to reside, or the municipality you choose to reside in, can have an impact on affordability because of the different tax rates. Another big consideration in terms of location is where do I work in relation to where I want to live. So we're all too familiar with the fact that the rising price of fuel is costing or making it more difficult to do a commute back and forth to work. So does 20 or 30 minutes away from work make sense when I'm choosing a location to live from my work? So there's increased costs and reduced affordability on the home. The other thing is the neighborhood that you choose. So what is the proximity to a school for my children? If you're planning to have children, something to consider down the road. If you don't already have children, is there access to public transportation? Maybe somebody right now is not using their own vehicle, they're using public transportation. So how close is it? What about recreational facilities? So is there a park close by for my kids if I plan to have kids down the road? Or is it, maybe I frequent the YMCA or something like that would be a consideration in terms of where you reside. Another thing is how close it is to shopping centers or shopping malls or your favorite place to shop. So all of these things need to be taken into consideration when choosing your home, because all of it can have an impact on the affordability of the home that you choose. When choosing a home, there is also another avenue you need to look at. So what type of home do I buy? There are a number of different options. First comes to mind, do I buy a single family home, a detached home, or do I buy a semi-detached home, or maybe do I buy a condominium, right? Each one of them has pros and cons. If you buy a condominium, you have an added cost in condominium fees for required maintenance of the condominium complex or the apartment building you live in. Another consideration would be, do I build a new home, or do I buy a new home that's already built, or do I buy a home that's for resale? Every one of those options has with it different pros and cons. So building a new house, there are some programs the government has because it's more energy efficient, so on and so forth, that could save you money. But it takes time to build a house. The other one is buying a new home that's already been built. Well, the benefit to you is that there's no maintenance on it. But the property tax could be somewhat higher. It really has its pros and cons. Resale homes are usually a good option for first-time home buyers. However, you got to be careful on the home that you buy because you're buying an older home, so the maintenance costs could be quite significant if you're not careful when buying the house. And we'll get into that a little bit more down in the presentation. So the next step, home. Now it's time to go back to your financial advisor or your mortgage professional and discuss with them your mortgage options. So they've kind of given you an idea of the mortgage. You may not discuss some of the finer details of the mortgage, but now is the time, now that you have the home, is to talk to them exactly how you want your mortgage to look. And you do have the power to talk to them and say, here's how I would like my mortgage set up. It doesn't have to be a situation where they tell you this is what your mortgage is going to be. So make sure you talk to them about your options. The first option on a mortgage, maybe not so much an option, but the type of mortgage that's available to you really has a lot to do with the down payment you have, is conventional versus a high ratio mortgage. So we talked a little bit about down payment. And in this instance, a conventional mortgage, so when you walk into your advisor, a conventional mortgage is you're putting 20% down on your home. There's no requirement for what they call default insurance, which I mentioned previously, and they're loaning up to a maximum of 80% of the value of the property. In this case, sometimes it's the purchase price. Not always, but usually it's the purchase price. So an example of a conventional mortgage would be I find a home, the purchase price is $200,000, I put down $40,000 on the home as my down payment. My mortgage is $160,000. In this case, and I'll talk a little bit more about it, is there's no default insurance, so there's money saved here. The next type of mortgage is what they call a high ratio mortgage. So in this case, I'm putting less than 20% down on my mortgage. So my lender, or the government in this case, says, okay, you're putting down less than 20%, the lender wants default insurance. And default insurance protects the lender as well as yourself as the borrower in the event that something happens and you're unable to repay your mortgage. The default insurers have programs that help keep people in their homes and help protect the lender from default. So in this case, so if I'm putting, say, 5% down on my mortgage, I do have to get the default insurance, which we're going to talk a little bit more about. But in this case, if I'm buying the same house for $200,000 and the down payment is now $10,000 or 5% or $10,000, the amount of my mortgage is $190,000. Insurance premium on a home of $200,000 with a 5% down payment is $5,225, which gets added to the mortgage. So in this case, my mortgage would be $195,225 versus the previous example of $160,000. So you can see there would be some savings there. The more money you put down, the more money saved. Insurance, as mentioned, it protects the lender and protects you as the borrower. Don't confuse it with mortgage life insurance. Mortgage life insurance is if something happens to you in the event of death, the mortgage would be paid off. That's not what mortgage default insurance is. It's provided by Canada Mortgage and Housing Corporation and by Genworth Canada. And it basically, as mentioned previously, they have programs in place that both help the lender and help you as the borrower if something happens and you're unable to pay your mortgage. They'll work with the borrower as much as possible. And if it comes to a point where the borrower can't pay back the mortgage, then the lender's protected in the event that the insurance will cover the mortgage for the lender. In all cases, there is a maximum amortization when having to have mortgage default insurance, and that's 25 years. But you can have any amortization up to that, and we'll talk about that more down the road. Touch a little bit on the premiums. So I mentioned the more you put down in down payment, the more money you're going to save. Well, it works the same with the mortgage default insurance premiums. So if you can see if you're doing 90 to 95% or putting just 5% down, the mortgage default insurance premium is 2.75%. If you put 10% down, it reduces it to 2%, and so on and so forth, down to 1%, or if the lender requires it on 80%, which typically they don't, would probably be 0. If you were to utilize a lender cashback program, you would be using the non-traditional located at the bottom of the grid there at 2.9%. So it is a little bit higher because you're using a non-traditional, what they consider non-traditional down payment source. That would be applicable to the lender cashback programs. What are some other options that you want to discuss with your mortgage professional or your financial advisor? And one of the big questions these days is whether to have a fixed interest rate or a variable interest rate. So much similar to a car loan, if you were to borrow to buy a car, you would pay back the amount you borrow plus interest. Well, it's the same with a mortgage, no different. And the interest rate can have an impact on the amount of time it takes to repay your mortgage. So have a good conversation with your financial advisor and ask them about the difference between fixed and variable rates. So I'm going to give you a little insight into that now. So a fixed rate or a fixed interest rate, the interest rate is fixed for a period of time. So an example would be 5 years. So that 5 years, I know my interest rate is not going to change for that 5 years. And also, because my interest rate is not going to change, my payments won't change either for that period of time. A variable rate, on the other hand, the interest rate is typically tied to what they call a prime rate. Prime rate in most institutions is 3%, credit unions is 4%. And if that rate changes, then the interest rate on your mortgage changes. If there are some institutions that offer both a fluctuating payment and a non-fluctuating payment, but most variable interest rate mortgages, if there's a certain level of changes in interest rates, your payments will change if they need be. Some of the benefits of the two, well, fixed rate, you know what your interest rate is going to be, you know what your payment's going to be for a period of time. Variable rates traditionally, over time, have offered the benefit of a lower interest rate. In today's environment, however, given the lower interest rate environment we're in, I would say that fixed is more attractive. There may be people out there that argue with me on that, but there's also the option of maybe utilizing both to take advantage of both situations. There are mortgages available out there that you could have some fixed and some variable. So make sure you have the conversation with your mortgage professional or your financial advisor about which option is best for you and most affordable for you. Another option on your mortgage is whether to keep it open or to close it for a period of time. The difference between the two, an open mortgage essentially is keeping the option open with your lender to pay it early, in whole or partially, at any time without notice. This could be in the form of, say, a line of credit where I can pay as much as I want when I want. It could be in a term, usually or typically 6 months to a year, short-term mortgage, and we'll get more into more term is down in a couple of slides, but usually a short term, I can pay it off early. These are typically not common with people who are first-time home buyers. But if you do buy a home and you know you have the intention of moving, say in a couple of years, it's not something that's going to be like long term, you may want to consider this option. But the drawback to an open mortgage is you're going to typically pay higher interest rates. The other option is to close your mortgage. So by closing your mortgage or having a closed mortgage, the lender doesn't allow it to be paid off in full, early or transferred to another institution without paying some form of an interest penalty, they call it. The way the interest is calculated is another presentation, but basically there would be an amount to pay back to the lender for paying out your mortgage early. And the benefit to closed mortgages, though, are your interest rates are typically lower. So most first-time home buyers will choose a 5-year term, which typically comes with it an interest rate in today's world, roughly 3.25%, 3.5%. And the terms can range from 6 months all the way up to 10 years in some cases, but it's yeah, you're unable to pay your mortgage off in full. However, you can prepay your mortgage in most financial institutions. Some are 10%, some are 20%, and that's on the original mortgage amount. So if I take out a mortgage of $100,000, most institutions will allow you to pay, if it's 20%, they'll allow you to pay $20,000 of it annually as time goes on without penalty. So another good discussion to have about which option is best for you when you're choosing your mortgage. So you've heard me mention the terms, or mention the words term and amortization a couple of times up to this point in the presentation. I just want to touch on what those actually are. So a mortgage term and amortization are two different things. So if I choose an interest rate, I'm not paying that same interest rate for 25 years. What I'm actually doing is agreeing to a certain amount of time with the lender or your financial institution about how long that interest rate will remain in place for. And that's the term. So you're actually going into a contract with your lender for a period of time, and most choose 5 years. It can be anything up to 5 years. And basically is saying that I agree to pay you as my lender to house an amount of interest that will be payable to you for 5 years. So what happens at the end of 5 years? Well, your term becomes renewable. Basically, everything's on the table again. You're going to negotiate with your lender a new interest rate. Hopefully, the interest rate hasn't changed, or the interest rates at that time haven't changed, but the interest rate could change if it's gone up or down during the 5 years you've been in this term or this contract with your lender. The amortization of your mortgage is different. It's how long you intend to pay back your mortgage. So typically first-time homebuyers or most people in any case choose a 25-year amortization, or I'm going to pay my mortgage back over 25 years. Keep in mind, you don't have to choose 25 years. You can choose 5, 10, 15, 20, 13 if you don't like even number, odd. If you like odd numbers that are different numbers. It's really up to you how quickly you pay your mortgage off. What I can say is talk to your advisor and ask them what the best option is. Don't just assume that you have to take the 25-year mortgage, because the faster you pay your mortgage off, the more money you're going to save. If you can handle a 20-year repayment, I would do the 20-year repayment, because you're going to save a very large amount of interest over the life of your mortgage. Another option on your mortgage you're going to want to consider is how you repay your mortgage. So I just want to go over an example. It's not an exhaustive example because there are different payment options on a mortgage, but most people get paid biweekly. And like myself, I like to pay my mortgage in line with how I get paid. So this is an example of someone who has agreed to the terms of a $250,000 mortgage at an interest rate of 4%, and they're going to pay it back over 25 years or amortize it over 25 years. So if we were to change the way we pay the mortgage from a monthly payment to, say, a biweekly payment, there could be some significant interest savings for you. So on the top of the table there, you'll see the monthly payment on that mortgage of $250,000 is $1,315 or 25 over the 25-year period. The alarming thing is, if you were to take that full 25 years and your interest rate was to remain at 4%, you're looking at repaying the $250,000 plus $144,000 in interest to the financial institution. So 1.5 houses almost. So what happens if I change my payments and just make them the same as when I get paid? So there are two options. There's say for instance I go biweekly and I go accelerated biweekly. Well, the biweekly option is basically taking that monthly payment and multiplying it by 12 and dividing it by 26. So I get really no additional payments on the mortgage. It's just basically taking that same monthly payment and doing it biweekly over the course of the year. So the amount I pay back is pretty much the same. There's a little bit of interest savings. You can see in the middle line there, the payment becomes $606.41. and I actually reduce the mortgage amount of time it takes back down to 24.9 years, and I save $350 in interest over the life of the mortgage. But what if I change the way the payment's calculated and make it an accelerated biweekly payment? Well, that payment, what we do is we take that $1,315 and we divide it by 2. And then we make 26 of those divided by 2 payments. The payment is actually $657, a little bit higher than the biweekly above it, $657.52, and we pay 26 of those payments. And what actually the impact that it has is your mortgage gets paid off in 21.8 years. So we've knocked almost 5 years off the mortgage, just under 4. And the total amount of interest you pay back is $124,000, for the life of the mortgage, the 21.8 years. If I had chosen accelerating my payments, I saved $20,455. Now, for some of us out there, that's a very nice car. So I would have paid for a car in the 25 years that I've lived in this house, to give that some perspective. So the faster you pay your mortgage off, it definitely helps to save money on interest, and can be significant. So just changing the way you pay the mortgage to accelerated payments can have a really big impact on savings and savings of interest. So talk to your advisor about your budget and what fits in your budget and what would work best as a payment option, because there are other options. There's weekly, there's semi-monthly, so on and so forth. Every institution is different, but there is a best option out there. So talk to whoever your advisor is that's setting up your mortgage about what works best for you and your financial position. So now that we've got the pre-approval, we found the house, and we've gone back to our mortgage professional and we've discussed the options on our mortgage, and now we're happy with the options that we've chosen. I want to talk a little bit about the sequence of events. So we've already covered pretty much up to the first 2 bullet points of this slide. What happens after I've agreed to the terms of my mortgage? So, and actually I've skipped a couple steps, so I'm going to go through them one by one. So you've got your pre-approval. You found your home. That's not the step. We skipped a step there, and essentially when you find your home, you have to put an offer to purchase in on the house. You have to offer the seller the option to purchase their home. And typically you want to make this a conditional offer to purchase. And by conditional, I mean that you want to put in there a condition of finance, that finance will be set up with a mortgage financial institution or a mortgage company in a set amount of time. So sometimes it's 5 business days, 10 business days, however long it takes to set up this financing. The other condition that you'll want to put in there as a conditional offer to purchase is on a home inspection. Especially if you're buying a resale home or an older home, you're going to want to have the home inspected to make sure that there's nothing wrong with the home, or there's no surprises after you move in. That could be very costly. And as first-time home buyers, it's probably not the case that there is tons of money sitting around to do major renovations. Something happens. So after you have the conditional offer to purchase, you essentially take that conditional offer back to your mortgage professional, and that's when I was talking about setting up the mortgage options. So you discuss the mortgage options with your advisor. They'd get you a mortgage approval based on that. So after you get the mortgage approval and you've agreed to have the home inspected after you've agreed to purchase the house, a home inspector goes out, you're happy with the inspection, there's nothing wrong with the home. Now's the time that you need to waive those conditions. So you can go back to the agent or the real estate agent that you're dealing with, and you advise them that I'd like to waive the conditions on this offer to purchase. At that point, when you do and you've signed off, you've now entered into a legally binding purchase agreement. So if for whatever reason after you've signed those conditions that you're unable to meet, your mortgage approval doesn't happen or something like that could cause you not to buy the home on the date specified on the purchase agreement, it's now a legally binding contract. So make sure that everything that you've done is proper before you waive those conditions. And at that point, once you're in that legally binding purchase agreement, you are now a homeowner. The next step is to actually sign all the papers and collect your keys on the closing date, and welcome to your new home. The closing date is essentially the date that you take possession of the house. And I want to talk a little bit about some of the documentation that you're going to need to find or get ready for your mortgage professional or your advisor as you go through the process. One of the things that they're going to need right away is an offer to purchase. So they need to know what property you're purchasing. Lenders will look at the property. They'll look at, because they may not like the property. They may not want to lend to that specific property you want to purchase. You'll need to bring with you the real estate listing from the real estate agent you might be dealing with, or maybe the online listing, or the offer to purchase and the listing are the first steps. Your advisor is going to ask you for income verification. So I've told my advisor I make X amount of dollars a year. They're going to want proof of that X amount of dollars. It could be in the form of a letter of employment. It could be in the form of a pay stub. It could be tax returns. So they may want 3 years of your last year's tax returns, 2010, 11, 12, as a way to verify the income that you've stated on your application. They're going to want down payment verification. So if you aren't using a lender cashback program, if you're getting X amount of dollars from your grandparents to help buy your house, then the lender is going to want what they call a gift letter from your grandparents stating that the money they're gifting you to help buy your home isn't money they have to pay back. If you have to pay that money back, then they have to add it in as a payment into that total debt service calculation that I mentioned before, and could cause the amount that you're qualified for, it could be reduced because it's considered another debt payment. Hopefully at this point, if you're a first-time home buyer, you haven't already been through a divorce or separation. However, if you have, they'll want proof of that through agreements, court orders, to make sure that any support payable is documented and added to the application. And at the point in which, as mentioned previously, when you are waiving the conditions on the purchase agreement, you do have to provide your financial advisor or your mortgage professional with the waiver of conditions. So that lets the lender know that you are now binded to buy that property. So that's some of the documentation that you'll need to watch and look out for as the process goes when you're finding your home and arranging your mortgage. So what resources are available to us out there when we're going through this process? So two valuable resources, as mentioned with the default insurance programs, are Canada Mortgage and Housing Corporation and Genworth Canada, the top two websites there. They have a lot of information about home buying, about their programs, how they work, and what the premiums they are and what they charge. Always good to take a look. There's good information about first-time buying and what to look for, what not to look for when buying a house, so on and so forth. So very good, useful tools. Realtor.ca is the actual website where you can actually find listings in the areas you want to look for a home. So if you're looking for a house in St. Catharines, you can actually search St. Catharines for all of the listings that are available at that moment in time in St. Catharines. So probably a website you're going to visit quite often. It gives you contact information for some of the real estate companies and real estate agents in the area as well. There are other websites, energy efficient homes. So there are government programs. If you buy an energy efficient home, that could have savings for you in the long run. Canada Revenue Agency is another good one. A website we refer to a lot here at the credit union because we feel the information is valuable is www.smarteraboutmoney.ca. There's a lot of useful tools and information on home buying, on mortgages. I mentioned difference between interest rates, so on and so forth. Some very good information there. And when buying the house, mentioned that different municipalities have different property tax rates. So the different municipalities also have websites to give you this information. So visit those and see what kind of property tax rates are out there. If you, in the home buying process, choose to build a home, you'll want to Google the local builders and see who's available to build a house or who may have homes that are already built that you may want to buy. And some other useful websites are the Financial Services Commission of Ontario or the Ontario Association of Home Inspectors to help you find a home inspector. So some good information in these websites, and not a lot of work to get to them and see what information is available to you in these. Don't forget that your financial advisor or your mortgage professional has all this information as well. So utilize them as well. Ask them questions. Make sure you're well informed, because this is the biggest purchase you'll probably make over time, or you may purchase something bigger down the road, but at least at this point in time, this is a very large purchase. So make sure you're considering all and getting all the information you need before signing on the dotted line. Through the process too, you're going to need some professionals in your back pocket that you can call on with questions, that you can get them for help in your home search and arranging your mortgage. First and foremost is your financial advisor. Your financial advisor is going to help you determine whether or not your mortgage will determine how much you can afford, if you qualify, talk to you about the different options in the mortgage, and so on and so forth. So they are probably the first and foremost, the most important professional you'll need. Real estate agent. It's always good to have a real estate agent to find a home, and also act as they can help you negotiate with the listing agent. So there are pros and cons to both, but typically you'll want somebody to help you find a home that can help you with the negotiation process with the seller's agent or the listing agent. The other professional you're gonna need is a home inspector, especially if you're buying a resale home, because there could be something wrong with the home you don't know, and you don't want to get stuck with a large bill to fix it after you've moved in, because there's the buyer beware principle out there. And if you don't ask and you don't find out, unfortunately, it's your problem after it's in your name. So to close the mortgage, so the date you take possession, you will need a lawyer to arrange all that for you. They'll arrange the change in title of the home. They'll do searches on the property to make sure there's no problems. And they'll provide you with the keys, and then also arrange to make payment to the seller and the seller's financial institution if that's necessary, so on and so forth. So those are four professionals. There may be others that you want to talk to, but those are the four professionals that you're going to need along the way during the first-time home buying process. So what are the next steps? So if you're just starting the stage of or inquiring about first-time home buying, book an appointment with an advisor, whether that be with us at PenFinancial or our mortgage specialist, Anthony Timpano, and find out what is available to you. Get the pre-approval so you know how much you can afford, what your purchase price you're looking at in terms of the houses you can look at. It'll save you time and money. Build that team of professionals, and then get shopping. Go find that house. It's a very exciting time. And you get in your house for the first time, it's a really, really great experience. So I wanted to take a moment just to talk a little bit about PenFinancial and what we offer and how we can be of service to you and help you through this process of first-time home buying. We are a Niagara-based, owned and operated cooperative financial service organization. We are owned by the people we serve. So even myself talking to you today, I'm not only an employee, but I'm also a member. I work for myself as I am part owner. And we make decisions based on the best interest of our membership. And not only that, the decisions we make are all made locally. So when you deal with a financial advisor in our branches, your decisions are being made in the branch, not by somebody in Toronto, but by somebody right there in the branch. We reinvest the income that we earn right back into our communities that we serve, either by hiring employees or supporting local charities, or however we can help put money back into our economy so that our local economies strive and they grow with us as a financial institution. So PenFinancial or a credit union is a great option to look for a mortgage. And typically, because we're small and because we do give back to our communities, we're not out there to make as much profit as big banks, or any profit for that matter. What we're looking to do is give you back that in terms of lower interest rates or reduced fees or what have you. So great organizations to deal with. Be through that first-time home buying process. We have been in existence for over 60 years in Niagara. We have about 15,000 members and growing strong every day, every year. We have over $350 million in assets with 94 employees, 6 branches to serve you, 3 in St. Catharines, 2 in Niagara Falls, and 1 in Welland. We're local, we're accessible. We're a homegrown organization that takes pride in providing our members with exceptional products and services, and will assist you at every stage in life, including this stage of the first-time home buying process. We are small enough to care, but we're also big enough to trust. So if you do choose us as your lending institution for your first home, we will help you through every step of the stage of the process, as well as carry you on into the future years as you become a homeowner, potentially growing a family. We'll help you through all life stages in the process. I'd like to thank you for joining us and your time and listening to our webinar. I hope you found the information in the webinar useful. And if you are in the process of buying your first home, I wish you all the best of luck. I hope you find the dream home that you've always wanted. Should you have any questions about the information in the webinar, or have specific questions about the home you're buying or mortgage needs, we invite you to contact us via email or phone anytime. All of our contact information is listed on our website at www.penfinancial.com. All of our advisors are available to meet you in person. We do have the option of meeting online in a meeting. So if you like this way of communicating on the computer in the comfort of your own home in front of your fireplace or your parents' fireplace because you're a first-time home buyer, we offer the opportunity to meet online. We also have, and I mentioned his name earlier, Anthony Timpano, our Niagara-based mobile mortgage specialist. He's available 24/7, can meet with you in the comfort of your home or your office to talk about the home buying process and how he can help you arrange a mortgage. Again, all of our information is located on our website, or you can contact us through our general mailbox at email us, all one word, no spaces, no periods, at penfinancial.com. That's email us at penfinancial.com, and we'll be happy to connect you with our advisor or Anthony, our mortgage specialist. Thank you again for joining our webinar, and have a great day. Bye-bye.